Okay, so let's talk about forming a partnership. As it mentions here, so the most common way for a partnership to form is when two or more partners, and those could be individuals or other entities as well. Other types of entities can form a partnership together. So, trying to think if like another partnership two partnerships could form a partnership. It can get really complicated when you're talking about all these different layers. For our purposes, we're talking about individuals, okay? But when two or more partners contribute cash, property, or services in exchange for a partnership interest. So in this case, you know, if it's cash, that's pretty easy. I contribute, you know, Drew and I form a partnership together, and each of us were 50-50 partners. I contribute $1,000, Drew contributes $1,000. Now the partnership has $2,000 to get its operations going. So we've contributed cash. Another way is through property, right? So maybe Drew contributes $1,000 cash to our partnership. I don't have $1,000 in cash, but I have a really beaten up truck that's worth $1,000. And so I contribute that truck to the partnership, and we're still equal partners because the fair market value of my truck was $1,000. His $1,000 was $1,000. So now we're still 50-50 partners. Another way is through providing services. So again, back to our partnership, Drew and I. Drew contributes again $1,000, but I don't have $1,000 in cash. But I have some skills that I can lend to the partnership. So maybe we've created a bookkeeping partnership. And I say I'm gonna contribute $1,000 worth of my own services to the partnership. So that's another way of contributing to form a partnership. Okay, we're gonna go through all three of those ways and how we calculate the basis of the partnership based on those three different methods. Again, so here's another example. Lawn care, landscaping, two partners, each contribute $25,000. So now the partnership has $50,000. They each have a 50% interest in this landscaping business. When that happens, when we form that partnership, there's no gain or loss on the contribution of the property. So a taxable event really hasn't happened at that point with regard to the partners, as far as the partners are concerned. So there's nothing that's gonna happen on the individual's tax return. You don't have to record any event at that point. But at some point when something does happen with the partnership, there may be a gain or loss that has to happen. So in order to determine what that gain or loss is, we have to keep track of our basis. Now, like I said, we've got two different types of basis with partnerships. We have inside basis and we have outside basis. So inside basis is the basis of the assets to the partnership. Partnership owns that truck, that $1,000 truck. If I had a basis of $1,000 when I donated it to the partnership, now that basis transfers over to the partnership, and it has $1,000 basis. It's the basis, the partnership's inside basis. We've got other types of assets. Say we've got a building, whatever the basis is in that building, that's the inside basis to the partnership. So the basis to the partnership is essentially all those assets. We need to know the inside basis for the partnership because we use that for purposes of depreciation. All the things that we've talked about before with regard to assets, that's what we're talking about here with inside basis. Now we also have outside basis. E. This is the basis of the partnership to the owner. Remember that partnership is an asset to the owner. So the partnership owns assets itself, Those have an inside basis. And then the owners own the partnership. That is the outside basis, the amount that is the basis to the partner. So just like any other investment, if I buy stock, I buy $80,000 of Bitcoin. Now my basis in that Bitcoin is $80,000, right? Because that's how much I paid for it. So the same concept with outside basis, but it's a partner investing in a partnership, right? So that's what the outside basis is. When a partner contributes property to a partnership, the basis of the property carries over to the partnership. So that truck that I contributed, if it was I had $1,000 basis in that truck, that was my basis. Now that becomes part of the inside basis of the partnership, that $1,000. It doesn't change. It's not based on the fair market value, it's based on what my basis is. So it just transfers over to the partnership. So the partners, at the same time, my basis, my outside basis is going to increase by the basis of the property that I contributed. So I contributed something that's worth $1,000. Now that $1,000 basis belongs to the partnership in the form of, now it's its inside basis, but now my basis in the partnership is also $1,000, my outside basis. So you get two different types of bases. This obviously is going to, like I said, this is going to be used for depreciation purposes, for any gains or losses to the partnership when they sell those assets, increases and as much as if they make improvements to it. So that truck had $1,000 basis, maybe they had to put a new carburetor in it, which extended the life of the truck, and that carburetor cost $3,000, and now the inside basis to the partnership in that truck is $4,000 because they added. So just like any other asset, like we talked about in chapter 6, that inside basis, all of those assets in the inside basis will fluctuate based on additions to them and will diminish based on depreciation, okay? And any gains and losses on the disposition of those assets will be based on the inside basis to the partnership. Whereas to me, for my own gains and losses, my personal gains and losses, and whether or not I get to claim any losses when my partnership experiences losses, that's going to be based on my outside basis. Okay, so you think of it as this is the partnerships from their perspective, their basis, and all their assets. This is the partner and their basis in the partnership itself. Okay, I posted this. I don't know if you can see it. So I posted this online to kind of give you a little bit additional explanation of inside and outside basis. Let me see if I can make this look bigger. So outside basis, or we're starting with outside basis. Basis of each partner's interest in the partnership. The partner's individual investment in the partnership, which includes the initial contribution and any adjustments, such as additional contributions that they've made along the way. So you made the initial $1,000 contribution, but then maybe next year you make another $1,000 contribution. You give the partnership $1,000 more. That increases your outside basis, the partner's outside basis. Or the partner's share of any partnership income or losses. Partnership income increases a partner's basis. Partnership losses decreases a partner's basis. Again, income increases it because the partner is going to pay tax on it. Losses decrease it because the partner is going to get a tax advantage of not having to pay tax. It's going to offset other income. Sorry, I need some more. Are your eyes getting glazed over yet? This is probably one of the harder concepts to understand, I think, anyway, for me. So for example, if a partner contributes cash or property to the partnership, their outside basis starts with the value of that contribution. It's also going to affect, if it's property, it's also going to affect the inside basis, right, to the partnership, based on what the basis was when it was contributed. The outside basis increases with the partner's share of taxable income and decreases with any losses, distributions, or withdrawals. So when they take money out, it's also going to decrease their basis in the partnership, for partners anyway. Outside basis is important for determining the taxability of any distributions, the partner's ability to deduct losses, and for calculating gain or loss on the sale of a partnership interest. Again, for individual events that affect the partner, right? That outside basis is going to be important. And it's up to the partner really to keep track of that outside basis. The partnership will keep track of the inside basis, but the partners needs to keep track of the outside basis. Inside basis, I know these are reversed from how I did this. Inside basis is the partnership's tax basis in its own assets. So the basis of the assets held within the partnership represents the cost basis of the partnership's property and assets, similar to how a corporation or individual has a basis in their own assets. Inside basis typically originates from the initial basis of the contributed assets when partners initially form or join the partnership. Can also be adjusted by additional contributions or purchases of assets by the partnership. So when the partnership itself purchases assets, that's going to increase their inside basis. Now it's also going to decrease it because by the amount of cash that was used to purchase those assets. But so that's, whenever they purchase an asset, that inside basis is going to be affected by that. So if a partner contributes an asset with a basis of $5,000, the partnership's inside basis in that asset would generally start at $5,000. That's what it carries forward. Inside basis is used to calculate depreciation, amortization, gain or loss when a partnership disposes of its assets. So these are assets now that are owned by the partnership. All right. Make sense? Hopefully that kind of helps as well. I just don't think they go into enough detail on that here. So here's an example. Bart and Alan. So they form an LLC to construct personal residences. Each one is a 50% partner in sharing income and loss items. By the way, that 50% is going to be determined by the fair market value of the assets that they contribute. That's the only reason fair market value is going to be used, is to determine what percentage ownership each person has in that partnership. So, who is this? Bart contributes these items. So he has some land that has a basis to him of $55,000. So he bought it for $55,000. Obviously, land doesn't depreciate, so that's whatever he bought it for. Fair market value right now, though, of it is $100,000, so it's worth $100,000. If you were to sell it, you'd get $100,000 for it. Equipment, with a basis of $35,000, but a fair market value of $50,000. Now we can probably assume that that equipment has been depreciated over time, and so that's why that's what the basis is, that it's lower than the fair market value. So he is contributing assets with a fair market value of $150,000. That's what's going to be used to determine his ownership percentage, but his outside basis is going to be this $90,000, the basis of what he contributed. Alan contributes these items. So he contributes cash, obviously fair market value is the same as the basis in cash. Office equipment, which has a basis of $30,000, fair market value of $40,000, and then a truck that has a basis of $5,000 but a fair market value of $20,000. Again, fair market value $150,000 for Alan, so these are equal, that's why they're 50-50 partners. Okay, that's really not what we're concerned about in this class. That's something that would be determined separately. So our focus, I just want to explain to you why it is they're 50-50, even though their bases are different. It's because of the fair market value of those items. So his total outside basis is $125,000. Okay, the partnership itself now has a basis in all of its assets of what? $215,000. Right? All of the fair market value, the basis of what Alan contributed, and then the basis of who is this? Bart contributed. So Bart's outside basis, $90,000. Alan's outside basis, $125,000. So again, they explain the difference between the fair market value. If Bart were to sell his partnership interest for its fair market value of $150,000, he's going to recognize a gain at that point of $60,000 because Bart got $150,000, but these assets that he contributed were $90,000. So he doesn't get out of having to declare and realize that gain, right? It's just that it's now kind of in a different form through the partnership. So partners' basis in their partnership interest is the sum of any money contributed plus the adjusted basis of property contributed. Now, what is this? Well, we'll look at this example. So Dave and Alyssa form a law partnership. Dave gave $100,000 cash to the partnership. Alyssa gave $100,000 of unrealized accounts receivable from her cash basis sole proprietorship. So obviously, Dave had a sole proprietorship he was an attorney. Alyssa had a sole proprietorship where she was an attorney. Alyssa had $100,000 that was owed to her by clients that hadn't been paid yet. So now instead of what she did was she donated that to the partnership. So now the partnership can collect that money, that $100,000, right? If they're lucky, they can collect that $100,000. Dave's partnership basis, even though they're 50-50 partners, right? Dave's partnership basis is $100,000. Alyssa has a zero basis right now though, because that accounts receivable has a zero basis right now. As the funds are collected on those accounts receivable, that will increase her basis. It's as though she made a contribution to the partnership, right? So instead of that they collect $20,000 of it. Instead of that money going into her pocket, it's going to the law firm, right? So it's as though she contributed that. But right now those accounts receivable have a zero basis. As they are collected, that basis will increase, and it will increase her basis as well in the partnership. What else do I want to say? Questions right now? I know I'm saying the word basis and partner an awful lot. That's the chapter. All right. So that's the outside basis. What is the basis to the partner in that partnership? Inside basis, this is the partnership basis. Assets contributed to the partnership have a tax basis for purposes of depreciation and also determination of any gain or loss once they are disposed of. What happens is the partnership steps into the shoes, as they say here, of the partner. So whatever the basis was to the partner, that's now the basis. The partnership is going to now adopt that basis. So my truck that I contributed to the partnership had a basis of $1,000 to me. I contributed it. Now the partnership has a truck with a basis of $1,000. Same thing is you step into the basis. The partnership steps into the basis. They also step into the depreciation schedule. So if I'm in year 3 of depreciating that truck, now the partnership is going to be in year 3 of depreciating that truck. So they're just going to pick up where I left off, right? They're not going to, it's as though nothing really changed. So the basis in the hands of the partnership is the same as the basis in the hands of the partner. So it carries forward. So they use this tax basis balance sheet. So this is a balance sheet based on tax basis of these assets rather than financial basis of assets. And when you prepare a 1065, and you guys don't have to prepare a 1065, by the way, so don't worry about that. You do have to do one of these balance sheets. And then you have to reconcile it with the financial balance sheet as well. A lot of, as it mentions here, a lot of small partnerships and businesses that don't have other types of, if they don't have to follow GAAP, a lot of times they won't. They'll just keep their financial statements on a tax basis because it makes life easier when they file their tax return because it's already on a tax basis. So this is what the balance sheet would look like for Bart and Alan. So $215,000 are our assets. Our equity, we don't have any liabilities right now, but our equity for each of these partners is their outside basis at this point. So the $90,000 and the $125,000. So that's a very simplified example of a tax basis balance sheet. Okay. Again, so the partnership is going to assume the depreciation schedule of the partner as well at the point that the contribution takes place. So partners in the third year, the partnership is going to start depreciating in the third year as if they always owned it, right? If a personal use asset is contributed for business use, the partnership's basis is the lower of either the partner's cost, what they paid for it, or the fair market value of the asset on the date that it was contributed. So the lower of those two, whatever they paid for it, or the fair market value of that item at the date of the contribution. So here we've got Jose contributed a piece of equipment to JWS partnership March 1st. So this is March 1st. That means that up to, so for January and February, Jose would be depreciating that piece of equipment personally on his Schedule C. But for the rest of the year, the depreciation that's going to be claimed is on the partnership return. Cost of the equipment was $20,000. 2023 was the third year of depreciation under 7 years makers. So the depreciation for the equipment will be calculated. So on Jose's Schedule C, obviously, he's going to get all of it for 2021 and 2022. For 2023, we would calculate what that full year depreciation would be, but Jose's only going to take 2 months of it. The partnership's going to take the other 10 months of it. Okay, so they're going to split it up in that year. He also contributed a truck that he used personally for 4 years. So this was his personal vehicle. Cost him $28,000 for 4 years ago, but its fair market value currently is $8,300. So lower of those two is $8,300. Depreciation, because it hasn't been depreciated before, that depreciation is going to start now at the date of the contribution. Okay, so it's not going to, and again, that's just because it's that depreciation has just started. Questions so far? You guys look so excited. All right, so holding periods. Remember, we've got long-term, short-term holding periods, all of that. Partners are likely to contribute capital assets, 1231 assets, and ordinary assets like inventory when they form a partnership. Generally speaking, the holding period of the partnership interest includes the partner's holding period for 1231 assets and capital assets. So if the partner had held them long-term, then they're going to be considered long-term for the partnership and vice versa. Okay, so it's going to be included. If ordinary assets are contributed, like inventory, accounts receivable, The holding period begins on the date of transfer, so it's gonna be a short-term holding period for those. It's as though they just went out and bought it, right? So if it's ordinary assets, it's gonna start on the date of transfer. Any other types of assets, it's gonna start on the date that the original holding period was in the hands of the partner. So the partnership holding period for the individual assets includes the partner's holding period for 1231 and capital assets. Again, the exception would be for inventory, accounts receivable, any of those ordinary asset items. So we've got KC contributed the following to CWS partnership. So a building and some inventory. So basis is 175,000. Fair market value of the building, 300,000. Purchased by KC 7-1 of 14. Inventory, well, inventory is an ordinary income asset. You know, if you sold it, it would produce ordinary income. So that's why it's an ordinary income asset. Basis is 50,000. Fair market value is 100,000, and it was purchased in 2018. So the building is a 1231 asset. The basis to the partnership is 175,000. That's just going to carry forward. Has a long-term holding period to the partnership. So that building, they're going to start as though the partnership always owned it in 2014, and then wherever they are in that depreciation schedule, that's where the partnership is just going to pick up. Inventory, though, is an ordinary asset. Its basis is still going to be the 50,000, but it's got a short-term holding period. When they sell, it's going to be taxed at ordinary tax rates. I mean, it's inventory. That's going to be taxed at ordinary tax rates anyway, right? Because it's going to generate ordinary income. All right. So what if instead of contributing an asset or money, we contribute services? So in all of these examples, the partner doesn't have to recognize any gain at this point, right? A taxable event to the partner hasn't occurred to this point. However, it's possible if a partner contributes services that there is a taxable event that occurs. So it's one of those rare areas where there could be a taxable event meaning that the partner is going to have to pay tax at that point. So when a partner receives a partnership interest in exchange for services, then that partner is probably going to have to pay taxes. So when they provide services, they recognize income to the extent of the fair market value of their partnership interest. So whatever the fair market value is of their interest in the partnership, that's the amount of income they're going to have to recognize. This can be kind of a bit of a pain because now you have to pay tax on income that you didn't actually receive, right? You contributed the services, but you didn't get paid for them at this point. You didn't get paid in cash. You got paid in the form of a partnership interest instead, but you got paid nonetheless for your services. And so just like any other time you work and get paid, you're going to have to pay tax on it. So let's look at an example here. We've got Russell, Kevin, and David. They form a partnership. Russell and Kevin are wealthy investors, so they've got some cash that they can contribute. David doesn't have any money, but he is a construction contractor. So he's going to contribute services to the partnership. Russell contributes a 20-acre parcel of land. Kevin contributes cash. David is going to perform all the work to develop the land into a high-end subdivision. So he's not going to get paid a wage when he does that, but instead he's going to get part of the partnership. So Russell's land has a basis of $200,000. His cash, the cash obviously has a basis of $300,000. The land, however, has a fair market value of $300,000. Cash has a fair market value of $300,000. And then these are the partnership percentages that they've agreed on. This would be something that would be given to you. Okay, you don't have to calculate what this is. David is getting a 40% stake in this partnership. So in order to calculate how much that is worth, what we do is we add up the fair market value of all of the assets that were contributed, and then we multiply it by his ownership percentage. Okay, so in this case, $600,000 total of fair market value was contributed by everybody else. He is getting 40% of, or 40% is being attributed to him, and as it being attributed to his services, it's as though these guys paid him 40% of what they contributed. So the amount of his contribution is valued at $240,000. So he's gonna have to pay tax on $240,000, and he didn't receive the cash for it, right? But what he gets in exchange is a 40% stake in this partnership, and his basis in that partnership now is $240,000 because he's paying tax on it. Anytime you pay tax on that income, you're going to increase your basis in it. Okay? Like I said, in essence, Russell and Kevin are paying David for his future services. So that would really suck to have a tax bill on $240,000 that you didn't actually receive, right? What he might do is maybe over the course of a few years spread that out so that his percentage actually isn't, his basis is just going to go up gradually in that. But so that's if you contribute services. So that's one of those areas where you may have to recognize gain on the formation of a partnership. Okay. Another time that you may have to recognize gain on the formation of a partnership is in certain instances where you contribute property with a liability attached to it. So you contribute a building, maybe your building has a basis of $100,000, but it has a liability attached to it of $200,000, which now the partnership is taking on. You're being relieved of that $200,000 liability, but the fair market value of it is only $100,000. In that case, you are going to have a $100,000 taxable event. So, partner who's released from a liability is treated as though they received money from the partnership. So, when they've got that liability that's being relieved, it's like the partnership gave them $200,000 to pay off the loan, right? Now they don't have the loan anymore, but now the partnership has the loan. This reduces their partnership basis. If other partners assume a portion of the liability, they're treated as though they made a contribution, which increases their basis. So that $100,000 or that $200,000 liability that I'm relieved of, if there are 4 partners, each of those partners, including me, is now responsible for our portion of it. So $50,000 a piece. That's going to increase our basis. But me being relieved of the $200,000 is going to decrease my basis. Once you do the math, if there's anything left over, that could cause a taxable event. And here's an example of that. So we got Angie. She's contributing an office building to a partnership for a 25% interest. So in exchange for the 25% in the partnership, she's giving them the building. It has a $300,000 fair market value, $160,000 basis, but it has a $100,000 mortgage on it. All right, so the partnership is going to take on the mortgage. Each of the 3 partners contributes $200,000 in cash. So here are the contributions of everybody. Angie, this is the $160,000 basis of the building. So now her basis in the partnership is $160,000. Each of these others, this is cash, so $200,000 each. And then the partnership is taking on this $100,000 liability divided by 4. So each partner now has a $25,000 responsibility for it. So that's going to be spread equally over these partners. So now, like Maria's 225, Angie is up to 185 for her basis. However, Angie is being relieved of that debt. She doesn't have to pay it now. She's $100,000 richer. It's as though the partnership gave her $100,000. So that that is going to reduce her basis in the partnership. Just like if the partnership gave her the money. So Angie's calculation is a little bit different in that now that $100,000 is going to bring her down to an $85,000 basis. Now in this example, there's no tax that occurs because her basis is still positive. One of the things about basis is it can never go negative. It is not allowed to go negative. You cannot have negative basis. If there's a calculation that causes a negative basis, the difference is taxable. And the tax is there in order to bring that basis back up to zero, right? You're gonna pay the tax. Anytime you pay tax on something, it's gonna increase the basis. So if this were $200,000, the calculation would be a little bit different. So let's say she had, so Angie, again, so here's the basis. So 160, 200, 200, 200. And then we've got the debt. And let's say that that was $200,000 instead of $25,000. And it's spread over each of them. So now we're gonna add 50. But the relief of debt is 200,000. Well, these folks don't have to worry about that. So for them, their basis in the partnership, so their outside basis for each partner, 250, 250, 250. But this one, oh, I didn't do it right. So, because we're still at positive here, aren't we? Because so this would be a 10 basis. Okay, let's do this differently then. Let's say 400,000. We'll just make it ridiculous to make this work. So that 400,000 now is now spread over the 4 partners. For each of these guys, it's 400. Here we're subtracting, so we were at 260 minus 400,000, now we're in negative territory, right? So we're, what is that, 140? Is that right? This is gonna be taxable. She's gonna have to pay tax on that, $140,000. But what that does, so she's gonna pay tax, 140, that brings her basis up to 0. Okay, because you cannot have a negative basis. If the calculation brings you below 0, you have to pay tax on that. That becomes taxable, and then when you pay tax on it, it increases the basis by the same amount. As I mentioned here, it can never go below 0. Here's an example of, okay, so $45,000 beginning basis, share of liability. Here they didn't change the liability release like I did. What they did was they changed the basis on the property. Instead of 160, now it's 45. So plus 25,000 minus her liability release of $100,000, now she's got negative 30,000. She's gonna pay tax on $30,000. That brings her basis then up to 0. Her outside basis in the partnership, up to 0. The only time partner recognizes a gain on formation, this is on formation of a partnership, is when you contribute services or when the partnership assumes a partner's liability in excess of that partner's basis. Okay? How we doing? I know, it's different. It's like a whole different concept, isn't it? Yeah, it's very different. All right.